Hello and welcome to this webinar. The title of this webinar is Trading Edge, and my name is Stanislav Bernohoff. I'm a full-time trader with over 11 years of experience in trading forex futures and CFDs. And today I will be a host, and I'm going to share with you some interesting information concerning trading. The title of this webinar is Trading Edge, how to win not immediately but definitely. So as you are able to see, we will talk about concepts and principles concerning successful trading, winning trading. Of course, it is not about short-term results. It is not about making money today or even on a weekly basis, but of course we will talk about some robust principles that allow you to make money in the long run, or at least in a medium-term perspective. Before we start, let's take a quick look at the disclaimer. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. Risk of trading in financial markets can be substantial, and you will have full responsibility for any of your trading decisions. Past performance is not a guarantee of future returns. With that, we are ready to start the webinar. And I want to start with something that I call the prediction fallacy. In other words, can you achieve consistency in trading successfully predicting market behavior? That is the question that every trader addresses to himself or herself. And it's not a very easy question because, of course, you have to predict somehow the market behavior, predict somehow the market action. But in fact, can you achieve the consistency or at least positive results if your prediction skills are not very good, or at least you can predict the market or predict price action in only 50% of cases? Well, the answer would be yes. Here you see a sample of winning performance, or a trading statement, for a period around 1 month or 3 to 4 weeks. We have 26 trades here and 50% of profitable trades and 50% of losing trades. Well, of course, we assume that our profitable trades exceed losing trades at least 2 times, and here in this example, in this particular example, they exceed more than 3 times. But what I want to say is that professional traders or consistently winning traders, successful traders, they don't pay too much attention to predictions. They know that they can absolutely achieve positive result having no more than 50% of winning trades. And in this webinar we will focus on principles that allow you to achieve this 50 to 50 relationship between losing and profitable trades. Because if you can achieve just this ratio, it would be enough to make money in a medium-term perspective or even in the long run. Because if you have asymmetrical trading opportunities, if you accept those opportunities, if you search for trades with more profit than a loss, if you search for an asymmetrical trading opportunities, it would be okay to have those parameters. And I will tell you more, it would be even okay that if you have 30% of winning trades in comparison to 70% of losing trades, it is also okay, it is also acceptable, but of course it's not maybe so good like 50 to 50. Well, of course, if you can achieve 60% of profitable trades, it would be also okay, but I will tell you that it is fair for strategies that are more short-term, for day trading strategies, day traders who are trading more actively. They want to achieve 60% or 70% of winning trades. I'm not saying that this is impossible and you should not chase for 60% or 70% of winning trades. But in fact, if you have just 50% of profitable trades, you can nevertheless make money, and you can nevertheless have a good performance, the nice winning performance. Of course, we assume that you accept asymmetrical trading opportunities with more profit than a loss. But I will tell you that successful traders and professional traders don't pay too much attention to being more right than wrong. Well, we have to distinguish here between short-term strategies, between scalpers or scalping, arbitrage, mean reversion, and trend following trading, breakout momentum trading. Well, in the second case, I mean trend following trading, of course it is fair to have maybe even less than 50% of profitable trades. For scalping, for arbitrage, for momentum trading, you should have to have possibly around 70% of winning trades. It depends on your trading method. It depends on your approach. It depends on your trading style. But in a nutshell, successful and professional traders don't pay too much attention to predicting. Predicting is not what we can focus on. Well, predicting the market is not very easy thing, because markets are not very predictable in a short-term perspective. Well, you might know that if you trade the market for a period more than 1 year, and every experienced trader will tell you that predicting the market is not very easy thing. Sometimes you see what is happening. Sometimes you can project the market action in your mind, and sometimes it works and sometimes it doesn't. The key here is to try to manage what is really manageable. Market is not manageable. We can just build assumptions and estimate the odds. It is not manageable. We can manage risk. And here we come to the first component, which is the most important component in trading, which is risk control. In trading, we just control the risk or manage risk. We are not predicting, we are managing risk. But it is not very easy answer. If you ask me what is a risk, the answer is not very easy. Because risk is not just the amount of dollars or euro that you are willing to lose or you're ready to lose in a single trade. Risk is a combination of two things. The first is a probability of success or failure. It is a probability, okay? So it's a number of outcomes in a total distribution of events. And the second is the size of your trade or amount of money lost or gained in a single trade. So a combination of two things. You cannot treat the risk just as a size or amount of money lost or gained, and also you cannot treat the risk as a probability of success, as just a probability of success. You should combine those things together, and doing so you get the idea of risk. If you get the idea of risk, you can control this risk, you can manage this risk. And you see that I have put the risk in the foundation of the pyramid of the successful trading. Okay, I would advise you to choose between two alternatives. The first alternative is that I pay you $300 if you pick the white ball. We have a black box, you don't see what is inside, and you know that you have 4 balls there, three white balls and 1 yellow ball. So you see that I pay you $300 every time you pick the white ball, and I pay you nothing if you pick the yellow ball. So here you have, you can guess that you have 75% of probability of gaining $300. Well, it is a random process, okay? It is pretty random. You cannot stack the odds in your favor. It is a random process, and that's why we can estimate the probability as 75%, 3/3. Okay, and the second alternative, I pay you $200 in case you pick the white ball. Of course, the majority, really the majority of traders and the majority of people, they make the second choice, okay? And it is explainable because they know that they will get their $200 in spite of any risks. They will get it in any case. How do you think? What choice is better? And the second question, what choice is better for a trader? Of course, if you want money to get money right now, you should pick the right choice. You should pick the second choice. But for a trader, there are no guaranteed payoffs. There are no guaranteed results. Trader has to accept the risk. And for a trader, the first choice is more acceptable. And I will explain you later why. And to be able to explain why the first choice is better for a trader, we have to talk about the concept of expected value. What is an expected value? It is a sum of probabilities multiplied by the magnitude or multiplied by the size of the event. Let's try to calculate. In the first case, we have 75% of probability, and to express it in numbers, we have to take 0.75 because 1 is equal to 100%. And we have to multiply this 75% of probability by the payoff, or $300. And we get $225 of expected value. Well, the expected value of this trade is equal to $225, okay? Well, this number is calculated by multiplication of 75% of probability and $300 of payoff. 225. And in the second case it is just 200, okay? And of course 225 is more than 200. That's why you should pick the first choice if you are a trader. In trading there is really no guaranteed payoff, and that's why it is impossible to pick the second choice in trading. Well, in real life, sometimes maybe you can pick the second choice if somebody allows you to make this choice. Okay, in trading you should take the first choice. It is just an example. It is just an example, and it is a very important concept. I want you to understand this concept, the concept of expected value, because if you learn to achieve positive expected value in your trades, you will understand how money is really made in the market. And here we come to the understanding of a relationship between equity and a balance. You may notice that some traders generate pretty stable positive returns. You may analyze, I don't know, you may analyze some ratings or some social trading platforms, I don't know, and you may see that there are definitely traders that generate positive returns. The balance curve goes consistently higher with 45 degrees angle, but their equity curve is always negative, which means that they hold losing positions all the time. They hold losing position. Their profits are relatively small and their losing trades are relatively large. In other words, they can afford, I don't know, 3-to-1 loss profit ratio, or their profitable or their losing trades can exceed 3 times their winning trades. Of course, in such case, when the market is random, when the market is stochastic, when nothing happens, it is easier to generate income flow in this case. But it is pretty dangerous because when volatility comes to the market, when the markets are unpredictable, when you have some extreme event, such trading becomes very insecure and very fragile. On this slide you see what was happening during the Brexit. You might remember that Brexit was the famous day when the British pound had lost around 10% of its value overnight. And uncertainty in the modern world is really high today. I would say that extreme events may occur or may happen possibly twice a year. Well, this year we have a Brexit, maybe some large bank can go bankrupt. I don't know, it may be whatever extreme event that will influence the market. I just want you to pay attention to this picture, to the screenshot, and remember that we should always place a stop. Some traders think that they have a stop in mind, but in fact, if you have the stop in mind, sometimes you can become a victim of extreme event, and it is just a matter of time, because uncertainty in the world increases, and it is a matter of time when you lose your money if you don't place your stop. It is a part of risk management. And also, as I have said, it is better to have equity curve above your balance curve. It is better to hold winning positions rather than losing positions. It may be not very easy, but actually when you hold winning positions, you're risking your profit, and your account is not insecure. If you are holding losing positions, sometimes you can generate large drawdowns. All right. Expected value and relationship between equity and a balance and placing a stop. Well, let's talk about the first goal of a trade. The first goal of a trade is to achieve robustness. Robustness, which is an ability to stay above water or keep capital in the game, not to lose much, and ability to cover your costs. It is the first goal of a trader, of a professional trader. It is a foundation. If you learn how to keep above water or achieve at least neutral performance, at least positive performance, you can build your successful experience, your successful trading experience on this foundation. You can filter some trades or add some good trades and turn this trading to profitability. But the first goal is robustness. Well, let's take a look at this list of key points of how to achieve robustness. Well, the first principle is always having a stop and never touching it except for managing winning trades. If you have a stop, if you place a stop, if you decided to place a stop in a certain point, well, it is better to leave it alone, because when you touch your stop, when you move your stop, you screw the odds of success against you. Alright, the second principle is being consistent with size of your risk. It is very, very important. Here, of course, I assume the amount of money that you are willing to lose in your trade. Well, if you decide to lose no more than I don't know 2% of your account in a single trade, you should not exceed this parameter. Being consistent with the size of the risk is really what professional and successful traders do. The third one is keeping positive expected value for every trade. What does it mean that you are keeping positive expected value for every trade? If you enter a trade, you know in advance your target. You want to know where are you going to exit this position, and you plan to take profit in a certain point. For example, you enter a position and you know that you would not exit your position once market achieves, I don't know, 1-to-1 profit loss ratio. No, you decide to stay in the game or stay in position until it reaches some certain target, and until, for example, you reach the 3-to-1 profit loss ratio. Well, in some cases, of course, market is not going anywhere and you achieve just 1-to-1 profit loss ratio in a single trade. But, well, it is what market gives to you. It is not what you want to take from the market. You want to take more, and you want to take some, I don't know, some 3-to-1, 4-to-1, 5-to-1 profit loss ratio or so. Well, in some cases it might be good to take 1-to-1 profit loss ratio when you I don't know, trading range bound strategies, scalping strategies, when you take small profits from the market, when you're trading inside this small choppy market action. In this case, of course, it is okay to take 1-to-1 profit loss ratio, but in this case you have to achieve 70% of winning trades. That's how expected value really builds in the market. The fourth parameter or fourth point is avoiding overtrading and occasional trades. It is a very big problem for beginner traders or those who are building their own trading style. They know how to trade successfully, but they start doing occasional trades and they are overtrading. When market is not giving anything within a large period of time, they think that 1 week is a large period of time, they start overtrading. They start making excessive trading activity, generating excessive trading activity. It's really big problem concerning trading discipline. I would advise you to pay much attention to this point, avoiding overtrading and occasional trades. Okay, the component number two. How can we really achieve positive trading performance? I would advise you to search for one good trade for the day, or for, I don't know, for the week if you're a swing trader, if you're holding a position overnight. If you are a day trader, I would not personally advise you active day trading as a choice. If you trade actively in out, you might remember that markets are not very predictable. They are not very predictable. Traders want to have stable performance. They want to earn some numbers for the month. They want to earn, I don't know, 10% for their account for a single month. Then they want to make 10% more for the second month, and so on and so forth. But in trading, really, it doesn't work that way. In trading, you earn small profit. Then, for example, also you can make a break-even trade. Then you lose some, you earn some, and eventually you capture a big day. It can be, I don't know, it can be 1 day out of 1 or 2 weeks of choppy market action, and eventually your performance will look like shown here in the right column. Traders have expectations that they will earn 10% every month, that will have stability. The first month, the second month, the third month, and fourth month, they would generate stable 10%. And that's an expectation. In reality, really, your performance will look like shown here. Some months or some days will be larger or significantly larger than other days or months. In other words, you can earn 30% a month, then the next month you can do 2% of increment for your account, then you will lose 2%, then you again will win 2%. If you combine all these numbers together, you will get 10% of a profit for a month. Okay, so 35 plus 2 plus 5 minus 2, it is around 40, which is 10% for a month. Real trading performance looks like shown at the right column of this table. That's why I would advise you to search for one good trade for the day to be able to achieve those big profitable days. Well, let's talk about anatomy of big day. What big days look like? And if you see at big candlesticks, white or black candlesticks, it's just an example from the euro versus American dollar, I believe, or any other currency pair, it doesn't matter. If you see that big days usually start moving early in the day and they end up without big pullbacks. In other words, big day starts an Asian session. It is not generating any meaningful pullback in the direction opposite to this trend, and then it starts moving in the direction of this trend, and market action closes somewhere in the lower side of this candlestick. Or in other words, you have black and white candlesticks with elongated body. Well, for the rest of the market action, you see that we have pretty long shadows. It means that those days are range bound. They are not too big. Well, if you capture 2 days like this in a month, really in a month, not in a week. If you capture 2 big days like this in a month, you're going to make your month, or you are going to achieve very good profitability for the month. It may be 15% or 20% a month, I don't know, it depends on your risk. But if you capture just 2 days in a month, which is possible, you already can cover all your costs and move forward, capitalizing on those days. Alright, so searching for one good trade for the day and focusing on big days. I will just show you a couple of examples of how I achieve this in my trading, or how I apply this principle in my trading. For example, for the July 5th of 2016, we had very small volatility for the euro versus American dollar, and we see that market was pretty choppy during the European session. So I was trading to enter this position early in the day. Then I was going short. Well, the first trade was closed with a break even, with no loss, but also no profit. The second trade was closed with a small loss, and eventually I had entered the position during the active hours of US session here. Market was not going anywhere. It is very active, a very volatile time, the US market opening, and eventually market action was going to go lower, and I was able to generate some profit. In this case, I have generated first 0 in the first trade, possibly a small loss of about 10 pips in the second trade, and around 80 or 70 pips, I don't remember exactly, in the third trade. That's a typical day. Well, of course, I would prefer if market goes directly to my target, but in some cases I have to re-enter several times to be able to get in this train. The second example is euro versus Japanese yen. Well, it is pretty good trade because I was able to enter early in the day, to enter the position early in the day, and you see that market opens at some point on Monday, June 19th or June 20th, I don't remember exactly, and it goes slightly to the upside. And remember that big days don't generate big pullbacks against the market action. In other words, if market went higher, significantly higher within this day, I was not going to fade this action to go against this move. No, it's not my option. But if you see very modest price action to the upside, and if we see a level of resistance that is good for building a short trade, of course that is the option. You know that the pullback is very small, so you might want to build a short position here near the level of resistance in this case, and market generates up to possibly 10 to 1 profit loss ratio in this trade. Well, I had not taken everything from this trade because there has been a pullback, and I have returned part of my paper profit back to the market. And also another example from Swiss franc, or American dollar versus Swiss franc. It's not a trending day because we had a very meaningful action to the upside. But in this case, it was very difficult to capture a trending day. I have decided to just capture volatility because I knew that the day possibly would have become external, the daily bar looking like this. So I was not opening during the first hours. Yet you see that also if you open the position at the first hour of trade at the breakout and not getting rid of this position, not placing your stop to break even, you also could have achieved 50 pips in this trade and comparing it with your loss stop loss equal to 10 pips, it is also 5-to-1 profit loss ratio, or at least 4-to-1 profit loss ratio. It's not a big day, it's not a trending day, but also volatility was very small at the beginning of the day. It's just an example. Well, mostly I like trades looking like this. When I open my trade early in the day and I capture a big day, then I just close this position for the next day, or I place a trailing stop. But if I enter somewhere here and exit somewhere here, I achieve more than 7-to-1 profit loss ratio, and I really make meaningful performance. I generate profit that allows to capitalize and to move forward. That's how we achieve those big days and big months. If we capture really big action, we achieve large day. We make a month in a single trade, possibly, I don't know. And the rest of the time we just want to fight with zero. We want to keep our capital. We want to be in a trade, and we earn some, we lose some, we generate modest performance, and just only to be in the market to be able to catch a big day, the one good trade. Component number 3. Don't chase the trade. Market will be there tomorrow. It is very important principle. Sitting in cash is a position. If you know that you capitalize on pretty rare market movements which can appear, I don't know, in 20% or 30% of entire distribution of trades, you want to be in cash very frequently. It's not so hard to earn money in the market when markets provide good opportunities. Earning money in the market is not really hard. It's not really difficult. It is much harder to preserve capital when opportunities are limited or absent. When market is not very good, when market is not very volatile, when it's not generating any meaningful action, it is pretty tough to keep your capital, to preserve your capital. Traders want to step in all the time. They want to be in the market. They want to speculate even there's no opportunities over there. So sitting in cash is a position. Don't chase the trade. It is very difficult advice to follow because in a real trading we have emotional pressure, we have performance anxiety, and we want to chase the trade. But we just need to learn not to chase the market. It is absolutely essential to be successful in a long run. All right. What does it mean that we are not chasing the market? What does it mean that we are preserving our capital? We are filtering. In other words, we are filtering our activity. We are getting rid of irrelevant activity. I call it filtering. We have 4 types of filters. The first is directional filter, the second is filtered by volatility, the third is filtered by timing, and the fourth is filtered by trade location. Let's talk about each filter in more detailed mode. The first, or directional filter, allows you to work in the direction of a trend. In other words, you accept only long trades, you don't accept short trades. When you see an active downtrend, for example, you can always sell but not buy. It is a directional filter. Of course, you have to be aware that trend is active. When you filter your trades by volatility, you trade only when markets have opportunity to explode, when the volatility is the lowest for a large period of time, and you know that your stop loss will be pretty small because volatility is also small, but markets can really break. Well, it is filtered by volatility. It's very nice filter. I use it all the time in my trading. Filter by timing means that you trade within most volatile time within a day. You stick to this time, you stick to the market opening, European session or US session opening, you don't trade, or at least you don't enter the market during the time outside of these window opportunities. And filter by trade location means that you trade near certain levels and areas. You don't trade in random point. You pick certain levels or areas to build a trade, because that's the way you can manage your risk. That's the way you can calculate your stop. Alright, the example, directional filter. In the context of a strong trending condition, you can accept only trades in the direction of a trend. That's an example of a American dollar versus Japanese yen. That was recent market action. And you see that Japanese yen was pretty trending. This market was showing nice trend, and you see that we have a lot of black bars, a lot of black candlesticks in a row. And of course, if you trade only in the direction of this trend, you can capture a couple of trending days, capture a couple of big days, and they will allow you to build your performance. And you see that there are no big white candlesticks. There are just no big white candlesticks. Of course, you have to be aware that the trend is active. Okay. Filter by volatility means that you focus only on situations when volatility is the lowest for some period of time. In this example, July 5th, we had the lowest value of the ATR indicator. It is ATR with parameter of 21 for the 30-minute chart, and which I use on my consistent basis. And we have seen that ATR was the lowest for the period of possibly 10 days or so. I don't remember exactly, but it was a large period of time. And market was ready to go. I don't know the destination, but it was ready to go. It is an example from Euro versus American dollar that I was showing you so far. And that time I've captured the pretty short trade that was not very big. It was not very big day, because market has not given big profit this time. But I've captured nevertheless, I don't know, 5-to-1 profit-loss ratio for my trade, which was pretty good nevertheless. You see that if I was trading before that day, I could have achieved nothing really, or it may be very modest, very limited result in a trade. Filter by timing means that we focus on the certain market hours, when market are ready to start the move. It is a European session start when news releases come to the market, when big market participants come and they push the market, it starts to move, the volatility increases. Also, it is US session opening. Because, for example, between European session closing and US session opening, there is a period that is called US pre-market. It is a time for manipulations, and there are many examples when you hold a trade since the European session opening, and then market just pulls back, takes your stop, and then resumes the previous trend. And that's why, if the market was not able to generate meaningful performance during the European session, I prefer to close my position during the US pre-market. It is a time for really manipulations. I don't want to be in position during that time, except for the situations when the market is really trending. And filter by trade location, as I've said, is working with the levels, with certain levels. It means that I'm opening positions only near some important levels or areas. In other words, if I want to go long, that's an example of breakout momentum trade. If I want to buy here, I would buy only near the level, in spite of the pretty large activity, pretty nice activity before that level. but I know that I don't have to jump in the market before it reaches the level. I would prefer to take 1/3 of the entire move, but I will know where to place my stop. If I know where to place my stop, I can manage risk, and that's why I can afford a good trade in this case. If I know where to place my stop, if I know that my stop loss will be, I don't know, equal to 12 or 15 pips, I can calculate my approximate profit loss ratio. It can be 3-to-1, for example. If I enter somewhere here, I don't know where to place my stop, because market can generate some choppy action before it goes. It will just take my stop, and later on I will see the market going straight to my target. No, that's not what I'm doing. I'm filtering my trades by trade location. Well, the tactical identification of levels is beyond the scope of our webinar, because it requires completely different webinar or separate webinar. We will definitely talk about principles of identifying levels and areas in next webinars, but what I want just to show you is the 4 key points, four filters. The first is directional filter, then it is filtered by volatility, filtered by timing, and filtered by trade location. Sometimes I use all those filters, but sometimes but directional filter is not that we can use very frequently, because we don't have strong trend all the time. It is pretty rare event. But concerning volatility, timing, and trade location, we have to use it all the time, because if we combine the good timing, if we combine the cycle of volatility to our trading, when we enter the market, when markets are ready to explode, when we choose the right trade location, we are about to get a good trade. And a component number 4. I will not talk much about this. I will just stress the importance of this component. It is building winning mindset. How do we build winning mindset? We always keep a journal. We write down everything that we do, because that's the way we can get back to this, get back to our journal and analyze our trades, make conclusions, and improve. That's the only way. We have to keep a journal. We have to track our performance. We have to write down our thoughts, emotional states, and then we have to highlight our successes. That's the second thing, because most traders tend to remember what they have done wrong. We have also remember what we have done right. To be able to build on our strengths, because we develop only when we build on our strengths, not when we eliminate mistakes. Then we should have process-oriented goals, focus on right actions, not emotions, and learn to experience pleasure from the process, not the result. Pleasure from the process, but not the result. It's very important, because most traders come to earn the money from the market. But eventually, imagine that if you are fighting with zero, if you have, I don't know, several days with no profit, with absolutely no profit, or with some loss, if you expect to capture a big day but market is not giving you anything, well, in this case you will have frustration, disappointment, and in this and to overcome those feelings of frustration and disappointment, you need to feel pleasure from the process, but not the result. I don't know how you achieve this. It's the matter of your trading style. You should pick the right trading style. You should experience really the pleasure from the process. Alright, thank you for listening. I hope that this webinar was useful for you. Thank you for your attention, and see you in the next videos.